All right, good morning, everyone. Before I introduce ourselves, I am going to start with a few housekeeping items. If you have questions while we are presenting, please type them into the Q&A feature at the bottom of your screen. We will answer these at the end of the presentation, but feel free to type them in as you have them. If the questions go long for the end of the time we've allotted, we will stay on to answer them as much as we can. And you should feel free, though, to leave if you have another engagement to get to. This session is being recorded, and a link will be sent out to each of you in the next couple of days. And so with that, I will get to our introductions. My name is Emily Blackburn. I joined Boulay in 2013 and have been a senior manager in the Estate and Trust Department since 2020. I specialize in trust estate and gift tax compliance, comprehensive estate plans, and probate and estate administration. I draw from my education in both accounting and law to be able to provide a variety of services for my clients. And in my free time, I enjoy all types of outdoor activities with my family and friends, sampling all of the desserts I can, and spending time with my husband, our 11-month-old daughter, and our 2 dogs. Today, for our presentation, I am being joined by Andrea Thermos. She is a partner in our Estate and Trust Department. She joined Boulay 10 years ago and was promoted to partner in June of 2021. She has over 20 years of experience in the estate and trust world, with her primary focus on tax compliance and planning as it relates to estates, trusts, and gifts. Andrea also serves on the MNCPA task force for the Estate and Personal Financial Planning Conference. In her free time, she loves to experiment with new recipes and entertain friends. In Boulay's Estate and Trust Department, we assist our clients in all stages of life. Through our holistic approach to estate and trust planning, we take into consideration the different objectives you may have throughout your life when it comes to retirement planning, charitable giving, and caring for your loved ones. We strive to develop an estate plan tailored to your objectives, giving you confidence in the future of your estate. This morning, we are going to give you some insights and basics about charitable trusts and how they can be used during your life as a part of your estate plan. There are many variations to the basic types of these charitable trusts. Today, we will be giving you a high-level view of some of the most common strategies. And with that, I will leave it to you, Andrea.
Thanks, Emily. Thanks for the introductions. So charitable trust basics. Charitable trusts is a trust which you establish to distribute assets to charity. There are various types that serve a multitude of outcomes and can be used effectively in an estate plan in which the grantor has philanthropic leanings. They are irrevocable. And what that means is once they are established, they cannot be easily modified or changed. To modify them, it typically takes a court action through a non-judicial settlement. However, an interested party can request this be reviewed by the court, so it is not an absolute resolution. In either instance, for Minnesota Trust, notice will need to be given to the Minnesota Attorney General's office since there are charitable beneficiaries involved. I'm going to cover the various types of trusts, charitable lead trusts, charitable remainder trusts, non-operating charitable foundations, and pooled income funds. And then later on, Emily is going to get more in depth about charitable lead and charitable remainder trusts. So charitable remainder trusts, so lead and remainder trusts, kind of, you hear them and they kind of go hand in hand. With the charitable lead trust, it leads with distributions of money to charity, and then distributes any remaining assets to the named beneficiary after an established period of time has run or lifetime. With the charitable remainder trust, assets to the named beneficiaries, the assets are distributed to the named beneficiaries first, and then any remaining assets at the end of the term are distributed, they distribute any remaining assets to charity. So with remainder trusts and lead trusts, they have further drill downs. They have something called a unitrust and something called an annuity trust. Emily's going to get more in detail about those, but basically a unitrust, the grantor receives payments for life that are fixed annually based on a percentage of the value of the assets. And with an annuity trust, the grantor receives payments for life based on a percentage of value of the assets on the date the trust is funded. So that's the difference is one is a fixed amount annually and one is based on an amount when the trust is funded. Property placed in charitable remainder trusts pay specified amounts of money for a specified period. And once that period has lapsed, the remaining property goes to charity. The time can be set up with a finite amount or for life of the beneficiary. And the beneficiary can be the grantor or someone named by the grantor, such as a spouse, their children, or someone unrelated. With charitable lead trusts, the unitrust type, again, the charity receives annual payments calculated on a percentage of the assets in a fixed number of years. So for a remainder trust, that unitrust piece was being paid to the beneficiary, and with a lead trust, it's being paid to the charity. And then for a lead trust, they also have annuity trusts, and the charity then receives a fixed annual payment every year. And these payments are calculated again on a percentage of asset value as of the date the trust is funded. A third type of thing is a private foundation, or what's referred to as a non-operating charitable foundation. They can be set up as trusts. They can also be incorporated. The tax reporting requirements are the same in both cases, but using a trust instrument eliminates corporate filing obligations. Charitable donations can be claimed on your income tax return each time you transfer assets to the foundation, and creating a charitable foundation also requires you to give at least 5% of the average value of the assets in the foundation each year. The fourth type of trust is a pooled income trust. And what that is that it's a fund established and operated by a public charity. You may know of donor advised funds. It's not a donor advised fund, but it's operated kind of similarly, where you're pooling your assets with other donors, but the assets are being managed by that public charity, and you don't direct, you aren't directing charitable contributions during your lifetime. You typically are receiving an annuity during your lifetime, an income stream, and then upon your death is when the assets go to charity. They are similar to a remainder trust, but there are a number of differences. And planning should be done with a skilled advisor who understands the differences. Next, we're going to go into the charitable trust administration. So control of the assets. As with non-charitable trusts, charitable trusts are under the management of a trustee. The trustee can be an individual, a corporate trustee, a charity, or any combination thereof. The asset management and distribution to beneficiaries is done in accordance with the trust agreement. A remainder trust provides a stream of income to non-charitable beneficiaries for a term of years or for life, with the remainder interest passing to charity. A lead trust is basically the reverse. It provides a stream of income to charities for a determined length of time, with the remainder interest going to a non-charitable beneficiary. And a pooled income fund generates income to the donor during their lifetime, with the distribution to charity occurring after their death. And lastly, for my part, gift tax returns. Each of these types of trusts do have a requirement to be reported on a gift tax return. With some, there is an additional deduction that can be deducted on their individual income tax return. The multiple factors in determining the reporting for gift and income tax purposes should be clear to the professionals preparing the documents and tax returns and working with you in your estate planning. Next, Emily will take you through more in-depth specifics of charitable lead and remainder trusts.
Thanks, Andrea. So I'm going to start out with charitable lead trusts. And as Andrea mentioned, this can provide an income stream to charity at the beginning of this, which is why it's called the lead trust, for a set period or for the life of the grantor. And then the remainder goes to the chosen beneficiaries. That can be someone in the grantor's family, it could even be the grantor. It kind of just depends on what the goals are in setting up that trust. Are there goals beyond just the charitable purpose? Are we concerned about estate taxes or things like that? Do we want to get assets out of the grantor's estate? In that instance, we'd want to leave it to someone besides the grantor for that remainder portion. With charitable lead trusts, when we talk about charities, a lot of people just automatically assume that we are speaking about tax exempt entities for income tax purposes. A charitable lead trust, however, is actually not tax exempt. It is a taxable entity. However, the function of the income tax in relation to that entity just depends on how it is structured, if it's set up as a grantor trust versus a non-grantor trust. And if you were with us for our previous seminar on irrevocable trusts, you may remember that a grantor trust essentially just means that the income earned on any assets within that trust are actually taxed as if they were owned by the grantor, even though they are owned within that separate trust. And so for income tax purposes, the grantor is just kind of reporting everything on their individual tax return like they normally would if they owned those assets outright. And if it's a grantor trust structure with a charitable lead trust, the grantor then is able to get a charitable deduction on the formation of that trust. So that's kind of where that charitable deduction piece comes into play. With a non-grantor trust structure for a charitable lead trust, the trust itself is going to be responsible for those income tax payments. However, that trust then gets the benefit each year of the payments made to charity and can take an offsetting charitable deduction. So oftentimes with a non-grantor charitable lead trust, you're not going to have any income tax liability anyway. It's all kind of going to be a wash. There are instances, however, where the income earned within the trust is going to outpace the amount paid to charity and that offsetting charitable deduction. And so it is possible that the trust will have to pay some income tax as well. So that's something to keep in mind with this type of trust structure. As Andrea also mentioned, there's two kind of standard types of charitable lead trusts that you typically see. The first one is that charitable lead annuity trust, which again, it's a fixed income stream. So it's going to be that same amount each year. Or there is a charitable lead unitrust, also known as a CLUT, where that income amount kind of fluctuates depending on the fair market value of the assets, and it gets recalculated each year. So something, again, that you want to keep in mind with these charitable lead trusts are capital gains. So because it's not a tax exempt entity, if you're transferring low basis assets into this, you want to keep in mind that it's possible, that either the grantor will have some income tax consequences from any assets that get sold and have capital gains, or the trust itself could possibly also have some liability if those offsetting charitable deductions aren't enough to cover. So just something to keep in mind for that. And then we can move to the next slide and discussing charitable remainder trusts. Again, just kind of the mirror image of charitable lead trusts, right? So it provides an income stream to the chosen beneficiaries for life or a term of years, and then the remainder is going to go to charity. So the difference here from charitable lead trusts, besides kind of the timing of when that charity receives those payments, is that charitable remainder trusts are tax exempt. It's completely tax-free entity. And so this is an opportunity to really take advantage of, possible capital gains and appreciation in assets, because anything sold within the charitable remainder trust structure is going to be exempt from that capital gains tax. So something to keep in mind. Another thing to keep in mind in relation to charitable remainder trusts and the type of assets that are funded into those trusts is that you cannot have S Corp stock within a charitable remainder trust. And the reason for that is this type of entity is restricted from being an S Corp shareholder. And so if for some reason, S Corp shares are transferred into this, it will terminate that S Corp's election. And so it's really important to make sure that you're aware of those kinds of things and all of the rules surrounding these types of trusts, so that you don't have, unintended consequences for that business as a whole. Charitable lead trusts can have S Corp stock, and the reason for that is due to the kind of income tax structure that I mentioned, that it can be a grantor trust, which is allowed to hold S Corp stock, and then if it's a non-grantor trust in that charitable lead structure, that trust is allowed to make an SBIT election, which would then also qualify it to be an S Corp shareholder. So just another kind of important thing to keep in mind. Also related to charitable remainder trusts is, considerations for that either income tax deduction or estate tax deduction. Kind of depends when it gets funded. If it's funded during life, there's a calculation done relating to that remainder benefit that's going to charity that gets reported on that gift return that that she mentioned. If it is funded as of that donor's death, if their will has something in there saying that when they die, the residue or some amount is going to be funded into this charitable remainder trust, then they are able to offset any estate tax liability. So it kind of just depends on the timing for that. And again, just reiterating the two main types here: CRAT, charitable remainder annuity trust, that fixed income annuity, and then charitable remainder unit trusts, that income fluctuates based on that fair market value of assets each year. So really just depends on, kind of what your goals are, what types of assets you're wanting to fund in there. With either way, annuity, unit trust, whatever kind of structure you're looking at doing, you want to make sure that you're going to have enough income to pay that income stream, whether it is a lead trust where it's going to the charity, or if it's a remainder trust where that income stream is going to the beneficiaries up front. Because otherwise what you're going to do is eat away at that principal, and ultimately all that's going to do is either give less to your beneficiaries, so your family or whomever you've left it to, or less to charity. So all important kind of concepts to be aware of, especially as we're in an environment like we are right now, where we're kind of seeing interest rates, in the market maybe not doing so well. These are things you want to keep in mind, and there are arguments for either type of trust depending on, again, what the type of assets are, what the income stream earnings are going to look like, your charitable goals, your estate tax goals, and all of those things. So very important to make sure that you're meeting with your advisors and everyone is aware of what that picture looks like. So all important things to keep in mind. And I think that's all I have for kind of those main high level, again, functions of these. We don't want to get too technical just because there are a ton of rules and regulations related to these types of trusts. There are also, within that lead and remainder trust, there are also many different kinds of ways to structure that income stream and things. There are flip and all kinds of fun acronyms, but we didn't want to get into that today because it's a little confusing and it's highly technical, and just wanted to give you kind of big picture and hopefully give you some good takeaways for at least considerations and things to be thinking about if this is possibly a strategy that could work for you. So with that, if there are any questions, we are happy to answer them as they come up, and go ahead and feel free to enter them into the chat box or the Q&A box.
Emily, we already have two.
Okay.
The first one is an endowment considered to be a charitable trust?
I think it depends on how that endowment is set up. If we're talking about like I think, for example, like private foundation, if it's set up as a trust structure, yes. But there are also many types of different charitable vehicles that this could potentially be. And so I guess in order to know that, you'd have to know how that particular plan or whatever it may be is actually set up. And with trusts, as we often say during these webinars, it all goes back to that trust agreement and how that trust agreement is written, what the language in there says. That's going to be the governing kind of instrument with that.
Right. And what kinds of desires that the grantor had. You know, they hopefully had that written into their document. We do have a second, it's a multi-piece. Why would a charitable trust create a separate entity private foundation as a vehicle to distribute grants to charitable organizations? Okay, they're two separate things. So charitable trusts are one type of vehicle that you can use for philanthropy, and private foundations are a separate thing. I don't think that one is not part of the other. And so go ahead.
Oh, all I was going to say is, and I don't know if this is maybe where this person is going for this, but there are ways, for example, with a private foundation, sometimes people like to set that up in addition to maybe a charitable trust structure, because a lot of times with the private foundation, if you set it up in the kind of corporate type of environment, you can have like a board of governors, things like that. And so you can actually have people in your family or whomever it may be kind of help kind of steer that in the direction you want to see that go. Whereas with the charitable trust, it's kind of set for the most part by the grantor, you know, in terms of how it's going to operate. And again, goes back to that trust agreement language.
I have a follow-up question then for that. So not with this, but just that came up as you were describing that. So could a charitable trust have the private foundation as the ultimate charity that it's going to?
That I don't know off the top of my head, and I don't want to answer that without
knowing the facts of the case.
Just because again, these are so technically based that I don't want to say, yeah, that's absolutely fine without, you know, again, referencing the various kind of code regulations and all of that on this stuff. So,
right. Because the follow-up question on this person's question was, would the charitable trust be distributing at 5% of assets to this private foundation? And does the private foundation only need to distribute at 3% of assets? And then is the private foundation the only beneficiary of this charitable trust? So I think that gets into a lot of planning.
Yeah, and I think, I don't know if this one, it sounds like this one may already be set up possibly.
In existence.
Yeah, and if that's the case, again, it's all very dependent on if the private foundation is set up as a trust, the trust agreement, charitable trust, obviously the trust agreement. If it's set up as kind of like a corporation or corporate structure, there's usually, you know, agreements in place for that too, that kind of govern how things are going to run. So I guess I'm not sure how to answer that without more information.
And the one question though, the private foundation only need to distribute at 3% of assets. Doesn't a private foundation have to do 5% of the average value each year? I think is what I read when I was doing my research for this. So I don't know that we answered this.
I know, sorry. We are happy to answer these more in depth too, if you want to email us, but without kind of some of the background of this, I don't know that we're comfortable.
Yeah, the person who asked it said, thanks, your answer was helpful. And I'll look a little more at the details of this organization.
Perfect. Right.
And then we have, can charitable trusts live in perpetuity or do they need to end at some point?
So they will end. It's, there's a set term. Again, it's term of years a lot of times, or that grantor's life, and that kind of determines what happens
And
to these things.
I know in some instances it's the life of a couple, so the
Yep.
second to die.
Yep,
So
absolutely.
I know that we have had charitable trusts that paid annuity to basically to both husband and wife, and then when one of them passes, then the annuity gets paid individually to the survivor, and then when the survivor passes is when the trust terminates.
Yep. So again, as we hammer out throughout this entire web series, it's all dependent on that trust agreement and how it was drafted. That's going to be the structure that the trustee relies on to administer that trust and see what needs to happen, either during that term of years, during the grantor's life, and then when they pass away, whatever that may be. So that's kind of how that goes. But do we have any other?
I don't see any other questions. I don't know.
I mean, I think you can get the sense just from kind of the small amount of information that we touched on today that these are very complex. A lot of planning goes into, the drafting and figuring out what type of assets should be involved. And it's important to get your advisors all on board with that. And not only that, I think oftentimes people lose sight of wanting to, either save on income taxes or save on estate taxes. But it's also, you're able to do these things solely to benefit a charity,
Right.
And if you just have charitable goals that you think this would be a great vehicle to do
Right.
that's also obviously a perfectly acceptable way to do it, that kind of gives you the benefit of also saving some taxes while doing that.
And the assets that you're using for funding can often, so if you have highly appreciated items, you can use those to fund your charitable wishes during your lifetime, and you can move that capital gain out of your own tax situation, and you move it into the charity, and typically you wouldn't have to pay capital gains taxes then. So there are those types of things. And also I've seen real estate that is been used, real estate or entities that have been used, privately held entities that have been used to fund to minimize the amount the tax effect upfront.
Yep, absolutely. So,
and I don't see any more questions coming in. So,
okay. All right. Well, that kind of concludes our presentation. Then we want to thank you for joining us today, and hope that you were able to get some takeaways from kind of our high-level discussion, of the information that we provided on these charitable trust structures. And if you would like assistance determining the best plan for your specific situation, we are here to help. Feel free to reach out to us. We're always happy to help. This session is being recorded, like I said, and a link will be sent out to each of you in the next couple of days. And this actually concludes our Anatomy of a Trust series. And if you have any suggestions for additional topics you think would be helpful to learn about, please go ahead and include them on the feedback form that will be sent out to you. That always helps us too, to know what people want to hear about, and the questions that are on people's minds. And again, just want to thank you so much, and we look forward to seeing you at our next webinar in the future.